Welcome back, everyone. Today we have an exciting topic on our hands, a comparison between two popular dividend ETFs, SCHD and DGRO. We'll be diving deep into the world of dividend-focused ETFs to help you make an informed decision about which one may be a better fit for your investment portfolio. So let's get started. First, let's understand the basics. SCHD, or the Schwab US Dividend Equity ETF, and DGRO, the iShares Core Dividend Growth ETF, are both renowned for their focus on dividend-paying stocks. However, they have some key differences that set them apart. Let's break it down. SCHD is designed to provide investors with exposure to high-quality US dividend stocks. It tracks the Dow Jones US Dividend 100 Index, which includes companies that have a consistent track record of paying dividends. The index screens stocks for 10 consecutive years of dividend payments, a float-adjusted market cap of $500 million, and an average daily traded volume of 2 million. It then ranks the stocks based on 4 equally weighted fundamental factors: free cash flow to total debt, return on equity, indicated annual dividend yield, and the 5-year dividend growth rate. This methodology aims to capture dividend growth companies with strong financial ratios. DGRO, on the other hand, is focused on dividend growth. It seeks to track the Morningstar US Dividend Growth Index, composed of US companies with a history of increasing dividends over time. The eligibility criteria for DGRO's index constituents include 5-year consecutive years of dividend growth, positive consensus earnings forecast, payout ratio below 75%, not being a REIT, and not having a dividend yield in the top 10% of its universe. The index weighs holdings based on the total value of dividend payments, providing greater exposure to higher yielding stocks, and maintains diversification with a 3% cap on individual holdings. DGRO's strategy emphasizes companies that exhibit the potential for sustainable dividend growth in the future. Now that we have a brief understanding of each fund's objectives, let's dive deeper into their key features and talk about some of the similarities and differences. Let's start with the similarities. Both ETFs have significant assets, ample liquidity, and are focused on dividend growth. They both track an index that follows a rules-based approach to select constituent stocks. Both SCHD and DGRO have very small expense ratios compared to industry averages. SCHD has an expense ratio of 6 basis points, while DGRO's expense ratio is 8 basis points. While it may appear that DGRO's expense ratio is 25% larger than SCHD's, in dollar terms, the difference is marginal. For every $10,000 invested into SCHD, you will pay a fee of $6 per year, and $8 per year if you invested into DGRO instead. While both ETFs hold many of the same securities, this is where some of the differences between the funds begin. SCHD holds 104 unique securities, while DGRO holds 446. Comparing the security overlap, while ignoring their weights, we can tell that roughly 55% of SCHD's holdings are also found in DGRO, while only about 12% of DGRO's holdings are found in SCHD. The large difference makes sense simply because DGRO has 4 times as many unique positions compared to SCHD. Another distinct difference is the dividend yield each fund pays. SCHD has a trailing 12-month yield of 3.8%, while DGRO only sports a yield of 2.45%. While the difference in the dividend yield is significant, it's important to note that based on total return, both funds have offered very similar results. I'll dig more into the specifics a little later. Right now, let's dig a bit deeper into the holdings and sector breakdowns. SCHD's index allows for a maximum allocation of 4% to any individual stock, while DGRO's index caps the maximum allocation at 3%. Both allocation thresholds are in place to allow for more diversification to smaller companies, but each fund can still be considered top-heavy, with the largest companies making up the bulk of each portfolio. The 5 largest holdings in SCHD as of June 16th were Broadcom at 5.59%, Pepsi at 4.29%, Cisco at 4.23%, Home Depot at 4.14%, and Coca-Cola at 4.08%. You'll notice that all of these positions are above the 4% allocation allowance, primarily driven by recent market movements. SCHD is rebalanced quarterly, or if certain daily weighing criteria are breached. The top 5 largest holdings in DGRO as of June 15th were Microsoft at 3.95%, Apple at 3.4%, Johnson & Johnson at 2.97%, JP Morgan at 2.86%, and ExxonMobil at 2.71%. Here we can also see that both Microsoft and Apple have breached the individual holding threshold of 3%, again due to favorable recent market returns. DGRO is also rebalanced on a quarterly basis and annually with new constituent stocks. A quick comparison shows that roughly 22% of SCHD is allocated to just the top 5 holdings, while DGRO's top 5 positions make up about 16% of its portfolio. Technically, SCHD is more top-heavy than DGRO, but this is in large part due to the fact that it has significantly less unique holdings. In terms of sector exposure, both funds have more similarities than differences. with large allocations to financial services, consumer defensive, healthcare, and industrial stocks. They differ primarily in their exposure to utilities and industrials. SCHD, compared to DGRO, has a higher allocation to industrials by 6.78%, consumer cyclicals by 3.59%, consumer defensive by 3.05%, and communication services by 3.02%. DGRO, on the other hand, has a higher allocation compared to SCHD in utilities by 6.29%, technology by 4.62%, healthcare by 3.72%, and financial services by 3.55%. The other minor differences are in energy exposure, where SCHD has a 2.12% higher allocation, and basic materials, where DGRO has the higher allocation by 0.38%. Neither fund has any exposure to REITs, as both underlying indices remove all REITs from the investable universe of stocks. Comparing both funds to the S&P 500, we can see significantly lower allocation to technology stocks, 14.9% lower than the S&P for SCHD, and 10.28% lower for DGRO. Both funds also have less exposure to communication stocks and consumer cyclicals, and obviously real estate. But both funds have larger exposure to financial services, consumer defensive, healthcare, energy, and industrials than the S&P 500. The lower exposure to technology stocks explains much of the underperformance both funds have seen in 2023 compared to the S&P 500. Keep in mind this comparison is done at a point in time and will change every day along with the movement of individual securities. Let's switch gears towards a dividend comparison. SCHD is the superior fund in terms of current and historical dividend yields. The fund currently pays a yield of approximately 3.6%, and during the past decade, its yield has oscillated between 2.5% and 4.3%. We can see the yield has progressively grown higher over time, with the peak coming during the 2020 pandemic crash. In terms of yield on cost, long-term shareholders of SCHD have seen their yield increase very nicely in relation to their original investment. The 10-year yield on cost is nearly 8%, driven by consistent dividend growth. DGRO currently pays a dividend yield of about 2.4% and has a slightly shorter track record compared to SCHD. Historically, it has paid yields between about 2 and 3.25%, generally lower than corresponding yields paid by SCHD. DGRO's yield also peaked during the 2020 pandemic crash, pushing above the 3% threshold. This was the only opportunity to pick up shares of this fund with a yield above this mark. The fund doesn't have 10 years worth of history, and given that investors would have started with a lower yield compared to SCHD, its long-term yield on cost is also slightly worse. The approximate 9-year yield on cost is just north of 4% today. In terms of passive income, SCHD is by far superior to DGRO, but let's see how each fund compares in terms of raising its dividend payments. SCHD has maintained a long-term dividend growth CAGR of about 12% since inception. It has raised its annual dividend consistently year after year. Some of these annual increases have been higher than others, with the lowest increase being 6.97%. DGRO's long-term dividend CAGR growth is a solid 9%, and it too has consistently raised its annual dividend year after year since inception. The annual dividend growth history is pretty good, with the exception of 2016, where investors only saw a 1.44% increase in the annual dividend compared to 2015. More recently, DGRO has also seen a few below-average years of growth, with a 4.18% dividend increase in 2021, while SCHD raised its dividend by 10.88% during the same year. Given the larger focus on dividend growth in DGRO's stock selection strategy, I was actually expecting to see more favorable figures here compared to SCHD, but that doesn't appear to be the case. It appears as though SCHD is a clear winner in terms of both the dividend yield and dividend growth. And this is a perfect opportunity to segue into historical performance. Since 2015, both SCHD and DGRO have generated healthy total returns that are in line with the S&P 500. SCHD has a very slight edge with a CAGR of 10.2% compared to 10.13% for DGRO. Comparing individual years, SCHD performed better in 2015, 2016, 2020, 2021, and 2022, while DGRO bested SCHD in 2017, 18, and 19, and thus far in 2023. The current year can be seen as a little reversion back to the mean, as SCHD finished 2022 with a smaller loss than DGRO, and this year we are seeing the inverse of that outcome. Additionally, DGRO's larger exposure to technology stocks is likely driving the better start to this year. In terms of total return, I think it's too close to call a favorite here. The only distinction that can be made is whether you prefer your return with more dividends or less dividends. For those of you that are older, you will likely prefer a larger income stream with SCHD, while younger investors could opt for the more tax-friendly, higher capital gains rate with DGRO. There's also the option to hold positions in both funds, and utilize tax loss harvesting by switching in and out of each fund. Before I move on from performance, let's take a look at one more metric, drawdowns. It's useful to see how each fund is performed during periods of market drawdowns, to see if there are any distinctions that may make one fund more favorable over the other. SCHD and DGRO, as expected, have very similar drawdown histories since 2015. Of the more notable market pullbacks, SCHD has seen slightly larger drawdowns in 2015 and 2018, while DGRO experienced a larger drawdown in 2022. The largest drawdown for each fund since 2015 was during the 2020 pandemic, with each fund falling by 21 to 22% as measured by month-end close prices. SCHD's longest drawdown period was 9 months, ended September of 2022. It then took 2 months for the fund to recover. Its longest underwater period was 13 months, between March of 2015 and March of 2016. SCHD is experiencing a drawdown right now that has extended for 6 months as of month-end May, with the return being down a little more than 10%. DGRO's longest drawdown was also 9 months, that also ended September 2022. The fund still hasn't recovered and remains underwater, for which will be its longest underwater period when it finally sets a new high price. The 2022 drawdown was nearly as bad as the 2020 pullback, with the total return dropping by 18.61%. The drawdown analysis points to both funds potentially being attractively valued, sitting nearly 10% below recent highs. To sum it all up, I think both SCHD and DGRO are premium dividend growth ETFs, worthy of sitting in most dividend portfolios. SCHD is a better option for those seeking a higher income stream today, while DGRO is more tax-friendly for investors with long time horizons. I have a sizable allocation to SCHD in my portfolio, but I do not own any DGRO. However, after taking a closer look at the fund today, I think I may initiate a position in the near future. I think both funds are likely to deliver similar long-term total returns and remain competitive compared to the broad US stock market. I'm curious to hear if you prefer one over the other, or if you already hold both funds in your portfolio. Let me know in the comments below. If you enjoyed the video, please do me a huge favor and give this video a like and subscribe to the channel. Thank you for watching and see you next time.